Thanks everyone for joining. My name is obviously Lance Rubin. I'm the CEO and co-founder or Chief Excel Officer of EXL Cloud. And today we're going to cover cash flow modeling in the context of actually building modeling skills, but also some design aspects of that as well. So I'm going to kick off now as we hit the 5 o'clock mark. So really what we're talking about is thinking about cash flow modeling in regards to how you prepare cash flow models, how you learn financial modeling, and a range of tips and tricks. And I'm going to show you a little bit about Excel Cloud towards the end, but this is not a product demo. This is really about understanding cash flow modeling and how you can leverage and build better models through, of course, our favorite tool, Excel. So we're going to cover some of the fundamentals of financial modeling. We're also going to cover some of the tech stack relating to modeling. I hope some of you like my latest background. It's quite techy. So hopefully there's a chat as well. So please, if you want to ask any questions or you have anything, just feel free to pop it into the chat. Happy for you to not just message me personally, but of course the group and people can respond. We're going to talk about how to build a quick cash flow model with scenarios using Xero data. How do you structure a daily and weekly cash flow model is probably one of the things that is often coming up in terms of people needing to do weekly cash flow models. And I'm going to show you an example of that. And then how do you continue to develop your skills in financial modeling is equally important. This is obviously just a start. And of course, we're going to talk about, well, what to next. So if you haven't heard of or seen Simon Sinek's Golden Circle, it's definitely something which I come to a lot around financial modeling and the success in being a great financial modeler and building great models. So the first thing is to think about, well, why are we building the model? What is the goal we're trying to set? Where are we now and where do we want to get to? It's really important we do that, because if we don't, there's a big risk of us building a model that doesn't meet the client's needs, building a model that doesn't suit the ultimate purpose. And that's an important part of really understanding what our clients want and what people want to get out of modeling. So the why, Start with Why is a book that Simon Sinek wrote. And of course, if you haven't read the book, there's a great YouTube video where Simon talks about Start with Why. So you need to diagnose where we are now and understand where we want to get to relative to where we are now. The next part is the how. So how do we go about building this model? What's the process? What are the certain components of the model? And how do we think about that? And how do we go about building a best practice model or a model that's really built that is going to withstand and be robust? So that's quite important in terms of the how. And then lastly, the what, which is the actual model or the forecast. So what is it? Is it a one-way? Is it a two-way? Is it a three-way? Is it a four-way? And I'm actually going to cover four-way modeling, which I don't think many people are familiar with. And what does a good model look like? Visualizations and what are the key aspects to that? And that's an important part as well, because it's no point in doing all that hard work to build the model and then it doesn't land with the people that are actually going to use it. So it's an important part of what we're actually going to deliver. But equally important is thinking not just about financial modeling, but entire tech stack, our entire technology stack. So what are we doing about automation? How are we thinking about automation in the context of what we are building? So Excel Cloud uses JavaScript to get data from the cloud into Excel. There's RPA, there's VBA, there's Python. There's a whole range of technologies, and it can be quite confusing. So understand, what are we doing in the automation stack? What are we doing in the analytics stack? So the important part is, is this about diagnostic, descriptive, predictive, or prescriptive analytics? All of these aspects are important in regards to analytics. Analytics is not the same as financial modeling and analysis. It all sounds very similar, but it's quite different. When we talk about financial modeling, which is, of course, what we're going to cover mostly in this webinar, is our traditional three-way modeling aspects, which is your income statement, your balance sheet, and your cash flow. But not every model has to have that. But of course, that's one of the gold standards in financial modeling is your three-way. You have sensitivities, the three S's: sensitivities, scenarios, and in some cases, simulations. So really, to understand this aspect of technology and finance decision-making and accounting is really to embrace all these three pillars in technology relating to finance decision making. But of course, across all of that is your mindset, the design thinking about the customer, thinking about the end user in mind, influencing. Of course, if you don't have great influencing skills, all these models and this automation, this analytics is not going to really help you get to where you need to be. Communicating, that's an important part. Storytelling, UI and UX, what's the user interface that you're giving people when you use a model? And what's their user experience? Do they really enjoy going through the process? Is the experience enjoyable? Is an important part. But as we know, with everything, none of this would work without data. So the extract, transform, and load process, the ETL process, which often gets referred to in analytics, is equally important in terms of thinking about our financial models. What data we're going to put into them, how we're going to refresh the information, and where some of the assumptions, what data are we basing some of the assumptions on, is an important part of the whole journey of making better decisions. So as I said, we're going to focus on the financial modeling and in particular cash flow modeling in this session. Also want to just touch on Excel. Why Excel? This comes up time and time again, and we see all the rise of these other tools, but really Excel wins by a country mile and will continue to win. And the main reason for that, it's its ubiquity. It's just everywhere. It's ease of use. There's a podcast which is coming out in another episode soon about low-code, no-code tools. Excel is the biggest used low-code tool. You don't have to write programming. It's really easy for most people to use. The flexibility is incredible, but the flexibility also is one of the downsides to Excel. So we need to build some structure and build some really good, robust logic around that. But we could literally develop any solution. I built a snakes and ladders game as part of Model Off in Excel. And so you could do amazing things. There's some incredible things people have done. Even the skyline of Melbourne has been built in an Excel spreadsheet. Not to say that you should, and you should not build an accounting system in Excel, although you probably could, but you'd probably rather use something like Xero. And then you have enhancements and add-ins and technology that bolster Excel beyond just what you have out of the box. So Excel will continue to win because it is the tool most favored by accountants. It's the tool that gets used by everyone. Other people can use it. Our stakeholders, business owners, and clients can use it very easily as well. But also gets abused. So how do we build a best practice spreadsheet? How do we build a best practice financial model? And I'm going to use the acronym FAST. It's actually one of the recognized spreadsheet modeling standards. And I like FAST because not that I use FAST in terms of when I build models, I use a different standard called BPM, but FAST has a great acronym and it's a great one for you to remember. So flexible, appropriate, structured, and transparent. And if you want to check whether your models comply or at least are built well, then look at the FAST acronym. So is it flexible? It doesn't have sensitivity and scenario analysis. Are the formulas built in such a way that allows you to recalculate, or do you have hard coding? Of course, if you hard code a formula, it's no longer flexible. It becomes locked. If my formulas are not consistent horizontally, it's not a great flexible model. So flexibility is critical. If you don't have flexibility, it's just a spreadsheet of analysis. And so we need to think about how do we get that flexibility, because as we know, George Barks, a great statistician, all models are wrong, some are useful. So how does a model become more useful? Well, it becomes more flexible. The more flexible the model is, the more useful it is, the more you can explore different alternatives, different what ifs. Is it appropriate? How appropriate is the logic and the outputs and the design? It's an important part of financial modeling and particularly cash flow modeling. Whether I am going to do a one-way, two-way, three-way, or four-way cash flow model, it needs to be based on the appropriateness of the purpose. Going back to the why, what are we trying to achieve? What is the purpose of this? And this is an important part of the appropriateness. You can calculate something many different ways. So is it appropriate that I use very long formulas, or should I be breaking the logic out into different steps and little flags? Definitely the breaking out the logic is better because you can see and you can calculate it. Of course, if we make very long formulas, it's harder to read. Checks and making sure that we have all of that. It's appropriate to have all of those things, but how many? So all of this, there's a bit of judgment. Do you use multiple workbook? Do you use single workbook? becomes whether it's relevant. What's the size of the data we're dealing with? And making sure we're not using Excel as a database, making sure that we fitting the purpose of what we're trying to achieve by that. The next one is structure. Do we actually have a good structure of our financial model? Can we understand where things are? Workbook structure, sheet structure, cell structure. Do we understand what the assumptions are? Are they well designed and laid out? Do they have a particular format? And are the sheets easy to follow? Is the logic easy to follow? Is an important part of structure, but of course the calculations and the formulas. If the formulas are badly structured, then the workbook will become inflexible, probably full of errors, and probably will become inappropriate. So you can see our structure is really the foundation of a good model. The last one is transparent. So if we have a financial model that people can't read and understand, and the logic is embedded in VBA or is hidden, or we sometimes have deep hidden sheets, that's not great. We want to give people the confidence to rely on the outputs of the model. And so if we're hiding things and things are less transparent and there's a bit of a black box, then of course the confidence level will drop. And if we think about what's the purpose of us building a model, is to help someone make a decision. Quite often an important strategic decision, they need to have that confidence. They're looking for that confidence. They're looking to you as the accountant or finance professional to build that confidence through transparency and showing your workings. So an important part of building a really great, robust model is applying the FAST acronym. Now, once you understand what you're trying to build, you then have to think about, well, I want to build it in a good way, well structured, but what am I building? So this is back to what is it the actual end product's going to look like? Is it a one-way cash flow, which is just the cash flow only or the profit and loss only? We're going to cover a one-way cash flow. One-way cash flows are incredibly easy to use because they don't have the complexities of all the accounting. It's cash in and cash out. Everyone understands that, particularly business owners understand cash. They understand cash very well. But the moment you start going to profit and loss and accounting and accruals and all sorts of things and balance sheet, the visibility and the understanding starts to drop quite dramatically. So, a two-way, you might have a combination of a P&L, profit and loss, and a cash flow with some reconciliation or differences for balance sheet movements. A three-way, of course, is the gold standard in building really robust models, and particularly for bankers and investment banks and corporate finance. Three-way modeling is, of course, the gold standard, as I said. But it's complex. It takes time to build. It takes time to understand. Many people don't understand it, and it is very time consuming. So whilst it's great from a robustness perspective, it can take a long time. Now, the four-way cash flow model is really bringing back, which is why you've got that arrow going back to the one-way, is bringing back the simplicity of cash. So we've got our income statement, balance sheet, and cash flow, which is based on the statutory format. So our cash flow is operating, investing, and financing cash flows. But that's quite difficult for someone to understand when they just want to understand cash in and cash out. So sources of cash and uses of cash. So the sources and uses of funds is the fourth statement in the four-way model. And that's a nice, easy way for us to go back to simplicity of the one way, but still keeping the robustness of the three financial statements. Of the three financial statements, albeit that people use the cash flow or the income statement probably the most important is actually your balance sheet. If you don't have a robust balance sheet, how do you know your cash flow is correct? How do you know your profit and loss is correct? So a balance sheet is an incredibly important part of the foundation and the structure of a really well-built model. But like I said, what's appropriate? It may not be appropriate for you to build the whole balance sheet. You just want a quick and easy cash flow model, then a one-way could absolutely do the job for you. So once you understand which model we're going to build, 1, 2, 3, or 4, we then have to think, okay, what are we going to put in this model? We absolutely need to have assumptions, and that's critical. Every workbook needs to have assumptions. Every model needs to have assumptions. And then there's obviously going to be related to those assumptions, formulas and logic. And so we're going to stitch together the data, the assumptions. It might be historical data. There might not be any data, depending if it's a startup. But we need to understand, how does that data map and transform to our chart of accounts? How do we build logic on top of that? Is it driver-based? You don't want to just say revenue percentage increase on prior year. We want to look at particular drivers. So understanding all those different parts of revenue, expenses, working capital, assets, capital, taxation, all of these things are important components, but you might not need to do full tax modeling because you may be a non-for-profit. So thinking about the appropriateness of what you put in is important. Now, what are you going to use as outputs or dashboards? So you might have a summary financial statements, you might have detailed, you might have valuations. All of these things are important. But one of the things I see that's missing most in financial models is scenario modeling or scenario management. This really renders the workbook or the model inflexible. And as I said, back to our principles of best practice, we want to have the flexibility. So making sure that your model actually contains a scenario manager is quite important for you to understand how does it change through various scenarios or various changes in particular assumptions. And of course, sometimes you want to make the model efficient. We don't want to have to reuse the same percentage like the tax rate. We might have a lookup. We might create appendices, alerts, and checks. So the model that's really built well has an area where it has validation and error checks is quite useful. So that sounds like a lot. We have the structured approach, we have the best practice, we have the type of model, and now we have all the bits that we want to fit into the model and all the components. But how do we go about it? What plan do we have? Do we even have a plan? And I think that's one of the challenges is, a client will ask us, they want a financial model or someone wants a budget, and we'll just go and build it without actually stepping back saying, okay, well, what are we actually going to build? How are we going to build it? Who's involved in the decision? What are the key milestones and the deliverables and the deadlines? And is the model going to be audited or not? And what are the risks associated with the model? There is always a risk. As I said, no model is perfect. No model is 100% accurate. There will be variations in the future compared to our model. So how do we manage that? How do we align the purpose of the model? Quite often, if there's not alignment on the model, we build it and it doesn't meet the needs of the people that are using it. So that's an important risk that we have to manage in terms of making sure there's alignment. Are we trying to build a model for growth in value, protection of value? Is it an IPO? What is the whole purpose? And who are the stakeholders? And what's the problem? What is the problem you're trying to solve with this model? Because if you don't understand the problem clearly, you're building a model and there's a risk that you might miss the mark. So once you've agreed on the why and the purpose, you then think about the what and what are we going to put into it? What is the data we're going to need and where's that going to come through? What is the particular design of that model, all part of that. And of course, then we go and we build it and we provide drafts and we have a review process. That's an important part as well, because as you build things, even as a financial modeler, when we build models, we don't know exactly the ins and outs of everything. But as we start to build, we uncover questions that we have to ask, which we hadn't thought about because it was so buried in the detail of what it needs to be done and what's the logic that's going to flow. And many times clients don't even know that either. So they don't know, we don't know. So we have to go through a review process. And then lastly, how do you finalize and maintain and hand that over? An important part of the longevity of a model, a really well-built model that has actuals coming through it and rolling, as they say, has a lot of value. And so we don't want to build one-time only models. We want to build models that constantly evolve and improve in accuracy. If you're not increasingly using that model more regularly, then how do we know if our forecasts are going to be accurate? So trying to make sure that our forecasts match our actuals and try and make changes to the assumptions and the scenarios is an important part of learning how to build a really robust model. So that's all good. Have a plan, have all these things, but guess what? We just don't have the time. And I think this is the biggest challenge for everyone. We've got so many other things. There's compliance to be done. There's returns to submit. We have to train our team. Modeling skills is not easy to find. Even when I was working at KPMG, it's a big struggle for them to find people with great modeling skills. It's a problem everywhere. And so an important part of building a robust modeling offering or financial modeling or cash flow offering is to improve the time and efficiency. So I'm going to go through a quick cash flow model, which we're going to do in under 10 minutes. So we're going to take you through a process in under 8 clicks that you can build a model. So we'll take you through that quickly using Excel Cloud. And of course, how do we structure a daily and a weekly cash flow model with Xero data? An important part of how you would approach that. So from a quick cash flow perspective, here what we have is the ability to pull information down, select a couple of entities. So I'm going to take you through this in a live demo shortly. But really, to be able to do that in 5 easy steps is an important part of developing a really quick cash flow model. And like I said, this is going to be a one-way cash flow model, just cash in, cash out, and not worrying about all the complexities of a 3-way. We're going to then pull data in a click. That pulls data from Xero using JavaScript, using the add-in into tables. Tables in Excel are incredibly powerful. So by building data, not just in columns and of numbers, but actually structured tables, means we can then leverage the data in many, many different ways. Tables are great. You can use them for Power Query in Power BI. You can query a table. And of course, you've got pivot tables, which feed off the back of those tables, and pivot charts and a range of other things. Then if you want to populate the base case input, so you want to have a baseline set of forecasts. Many cases, people just copy the 12 months of actuals, but of course, that's a good starting point, but then you want to make changes on that. You want to maybe uplift revenue expenses as you need to. And then you can adjust those, each individual line item or particular timings. The fifth one is probably the most important one. It's certainly the one with the most value. It's the scenarios and scenario management. So we create a base case. We want to copy the base case to other scenarios, and we want to play with, your bookends, your base case, your best case, and your worst case. So in most cases, excuse the reuse of that, most times you have 3 scenarios because you want to really look at the best scenario, the worst, and somewhere in the middle. So most people can really get their heads around 3. Anything more than that, it becomes a bit too much. Of course, if you want to do Monte Carlo simulation, then you're talking about thousands, but there's very few people that actually get the value out of that, albeit can be quite powerful. So what we do is once we've built this cash flow model, we then have a forecast cash flow. We have a combo dashboard, which we can compare different things. We have a scenario dashboard, which you can compare scenarios side by side, and also the scenario comparison. So I'm going to show you all of these and pull that together, like I said, in under 10 minutes, and we'll have some time to go through that, and you certainly can ask any questions. So that cash flow model is a monthly model, and monthly models, monthly cash flow models or monthly 3-way models are really useful because we close our books every month. We post journals every month. We don't tend to close it every week, and we certainly don't close it every day in terms of accruals. But quite often, particularly now, more and more people are wanting a weekly cash flow model because cash is tight. So we want to really understand, are we going to meet the creditors and supplier invoices in time? Are we going to be able to collect cash from our debtors? And so quite often, this weekly cash flow model comes up in discussion. And managing cash, if you have to start managing cash on a weekly or daily basis, the business is clearly under a little bit of stress. And so it's important to be able to do that. So what we can do is we can set up initially a daily data set. So we're pulling information out of Xero into structured tables, and then looking at a pivot table to really understand what's going on a daily basis. We can then slice and dice that and look at that in different views to really understand how the information is structured. If you haven't been made aware, or if you haven't seen dynamic arrays, it's an incredibly great innovation by Microsoft that came out in 2020. Dynamic arrays allows us to use data dynamically. So I'm going to show you how to use one of those called Unique, one of the dynamic array formulas. It means out of the entire data set that we've pulled, we can actually pick up the account names, the unique account names that are impacted, and we can build our forecast off those unique names. So from a cash flow perspective, we can pick up all the different line items, which is really very useful. Once we've got the data and we've got the unique names, now we want to structure a time series. So we can actually structure day to day and aggregate the transactions, because there might be multiple transactions on a particular day relating to advertising, for example, and you want to aggregate that. So you aggregate that over time. So you have a day time series, and then you pick and aggregate using some ifs. And of course, because we ultimately want to build a weekly cash flow model, we have a week name, and we actually use that as a counter. So being able to use that week and aggregate means we can then take our daily data and aggregate it up into a weekly time series. So in setting up the weekly time series, we structure the time series for those weeks. Week 1, 2, 3, 4, 5, etc., etc. Now, different businesses have different times when their weeks start. Maybe some of them's on a Monday, maybe it's a Wednesday, maybe it's a Saturday. It all depends on the business model. So making sure that we have that, but also making sure there's error checks when we're aggregating daily data up to weeks. Feel free. I don't notice there's no questions in the chat, but if there's anything that you want to clarify, want me to explain, feel free to just pop it into the chat. So we then start to aggregate that using, again, some ifs, and then we can start to create some logic on a weekly basis based on that information. And so we can have logic blocks and also separate what's actuals from forecast, because really what's happening is we're trying to aggregate the information for what's actually come in versus what's going to be predicted in the assumptions that we're looking forward. So the weekly time series, we can then add conditional formatting and add a particular flag to actually show what period is actuals versus what period is forecast. And I'm going to show you that in the example. Then we can start to summarize those items. We might want to summarize them based on the account name, or we might want to summarize them in operational, investing and financing cash flows, or we might want to aggregate them in some other way. Again, we can use some ifs. But let's not forget the whole purpose of doing this cash flow model. The whole purpose is really to understand if we've got a cash issue, if we've got a gap in our cash flow. And so having a dashboard that clearly shows what the cash flow gap is incredibly powerful and useful. It certainly will help us get to understand and manage the cash flow looking forward if we understand what the gap is. So that's an important part of the cash flow model, is actually the outputs and the dashboards, and understanding that gap. And if there is a gap, how do we close it? How do we fund it? Do we delay paying creditors? Do we, offer some discounts to debtors to pay early? Of course, that's not a great result, because obviously we're going to erode our margin. So, or do we have to do other things like get some funding, working capital, or do we need to get some equity from the owners of the business? So when we want to build all of these, we can look at the daily transactions. We put a pivot table to analyze. We then can sum it up on a daily basis, sum it up into weeklies, and put some forecast flags and logic. And then, of course, we want to have print-ready dashboards that we can share. So an important part of all of that is really trying to break up those steps. So if you're going to build your cash flow model, your daily or weekly cash flow model, definitely think about taking this approach in terms of, now you may not need to use, of course you can do it without Excel Cloud, but making sure that you have some of these components, making sure that you have some of these aspects that we talk about in terms of building that. So I'm going to jump into Excel Cloud now and show you the cash flow model first, and then we're going to look at doing the daily and weekly cash flow. So if I just took a quick time check, it's now almost 5:30. So Excel Cloud sits as a ribbon that's using Excel Connect. And if I click the Start menu, it'll open up the range of content that we have around reports, dashboards, consolidation, data push and pull, and models. So I'm going to click the one-way cash flow model and open it up. So what we have is the ability to look, and I'll zoom in here. Every single workbook here works using a master control. We just select the different parameters of what period we're choosing, what currency, and then what's the financial year start. Of course, if for a junior in, July is the start. If it's December, it'll be January. In New Zealand, I think it's March, so it'll be April is your start. We then click Get, and what that allows us to do is get the list of entities that we're connected to, and then put a little cross next to the entity that I want to aggregate. In some cases, I might have multiple entities. I could do that as well by putting an X next to each of these. And it's puts that there. But of course, I'm not going to be pulling client data in this webinar, and the demo data is a little bit, it's not rich with information. So what I'm going to do instead is I'm going to pull our demo data. But you then click the pull button and it'll pull and populate. Just to show you, I've got nothing populated. It's not a pre-populated workbook. I'm going to go back to the master control and I'm going to click the demo data. So click yes. And what this is going to do, it's going into Xero, it pulls down the data and allows it to be populated. So in a couple of seconds, we're going to see data populated in the trial balance. So what we have pulled, because it's a cash flow model, we have pulled information from Xero on a cash basis. The reason we've taken a trial balance is because we don't just want to take revenue and expenses, we want to take the full cash flow. So as you can see, this is structured as a table. We can see the table menu pop up here. So this is already designed with headers already for us, ready to go. We then have a pivot table. So as you saw before, there was nothing in the pivot table. Now there is. This allows us to look at the data in slicing and dicing nice and easy. So we can really have a look at, accounting costs. We can look at that across different entities. We can look at that across the whole group. So a pivot table is really useful for quick and easy analysis, because we want to understand what's the trend, what's actually happening with that entity to really make sure that we understand what's going on. Then we have our base case inputs. What I'm going to do here is I'm actually going to clear these inputs. Typically, when you pull a new data set, this will be blank. So it'll populate the data 2A and 2B, but then you'll have your base case input or your base case forecast. So at the very least, you might want to copy the 12 months of actuals. So that allows us to do that by clicking this button. We're going to copy 12 months of actual data. But of course, we can make some changes. So I can make this 600. I can make this 40,000. And I can just go ahead and I can make those particular changes, positive and negative in terms of cash flow, cash in and cash out. I can also change these to be percentage basis or dollar amount basis. Now, sometimes you might want to apply a blanket uplift across these numbers. So rather than just taking last year's, you might want to start with, let's say you have contracts that are locked in and that allow for a 5% increase in revenue. Let's say there's a 2% increase in costs, and I want to apply that uplift. So I can quickly click uplift. Let's just have a look at those numbers. After I click yes, you'll see they will all be updated and okay. So once we've got our base case inputs, we've got a base set of forecasts that we can then start to look at scenarios on top of. So an important part of this process is setting that baseline. So I'm going to click next. What I'm going to do is there's already pre-populated scenarios. I'm actually going to save these, and I'm also going to zoom in so you can see. So I'm going to save these inputs. And once these are saved, I'm then going to clear what's sitting there. So we want to clear the scenarios, yes. We don't want to clear the saved because I want to bring it back after I've worked on the scenarios. So if we want to look at this particular example, we have a selection of which organization we're going to put the scenario on. So let's take Australia. We're now going to look at our revenue in the account type. Maybe we want to look at the main income. The behavior of that is listed here in terms of how the logic will work. We've done all the hard work for you. So percentage growth rate, repeats the number, spreads it. Start and end is like a drawdown and a repayment. So, like a loan. So you would use that for a working capital facility or an advance. And the bullet is just at the end. Let's say we've already drawn down and we just want to do it at the end of a period. Then we'd use the bullet. So let's use repeat for this one. We're going to start this in August. Maybe we're going to go for 5 months. And here we're going to put in $10,000. So straight away, that is inputted in there. If I make this 4 months, then it'll automatically does all the hard work for me. So all those formulas are sitting there on the right. But of course, revenue can't go up without expenses. So maybe we do the same thing for Australia. We pick up the expenses. Here, what we're going to select is other indirect costs. Now what we're going to do, instead of taking the repeat, we're going to spread it. Maybe we have some costs that start straight away in July, and maybe this run for a bit longer, for like 6 months. What I'm going to do is I'm actually going to make this 100,000 so that the scenario looks a bit better when we go to our dashboard. You can see the numbers a bit better if we use 100,000. And so let's say this is an expense of 25,000 over 6 months. So straight away, this changes spread. If I change that to repeat, the numbers change for me and repeats that number. Of course, with all of those things, it's nice and easy. And we've done that already for you. However, as I said, a scenario is often contained with 3. So here's our base case, our base scenario. Now we have best scenario, and now we have our worst. We don't have information across all of them. Maybe our revenue multiple is 6 times and our EBIT is 4 times. So this allows us to get valuation. What we want to do now is we want to make it easy for people to do that scenario. So what we do is copy the base case, click yes, and straight away, it's copied those scenarios downwards for me. So I'll look here. Now we look at our best case and we say, okay, well, on this basis, maybe it's 120,000. Maybe the best case, we obviously can't increase revenue without some increase in cost, but maybe it doesn't go up too much. Maybe it's just 27,000. So we can pick all of that up. The negative straight away, because that's an expense. If it's a balance sheet item, we just use positive and negatives for the cash flow. Maybe our valuation in this case for revenue multiple is 8 times and 6 times for EBIT. The reason it's not EBITDA is because we're already pulling cash only basis in our trial balance. There is no DAR, there is no depreciation and amortization. Now, under the worst case scenario, let's have a look at that. Maybe we don't get 100,000, we get 80,000 and maybe 25,000. We have a small saving in cost, but probably not a lot, 24,000. And we're picking that up. And maybe here it's not 6 times, it's 4 times. And then maybe that's 2 times. And that's it. So 36 minutes in and we are done. Sorry, that's 6 minutes from when I started. We are done with this model. So if I look at my forecast cash flow, I'll just collapse that. So we just look at the forecast period. So we have best, worst, and base. So we can see all of those numbers changing. What we're going to do then is look at our combo dashboard. So we can look at base, best, and worst. So we can see some valuation changes here. We look at the particular entities as well for Australia. We can compare those as well. What we're going to do is when we go to the next dashboard, you'll see straight away we have that shown there in terms of the demo company in Australia and July. I don't have to go back and change that. Now we can actually see the different scenarios side by side. If I zoom out, we can see that a lot better. And actually shows you the impact on EBIT. It shows you the impact on revenue across those different entities across. Let's change this to August. I think that'll show that variation a bit better now. So 964, 984, I'll just zoom in a little bit here. So we can see that variation in the revenue. If I go back to my combo dashboard, I will see that change as well. Now I want to look at my scenario comparison, and I've got different valuation metrics as we saw. If I'm changing from a revenue multiple to an EBIT, all of that is showing there. So I can have a quick look at information side by side, and I've built all of that cash flow model really easy. I go Control P and it's print ready into PDF, and I can send that out. So very quickly, I can look at all of that. But let's say I didn't like those scenarios and I want to go revert back to what I saved before. So let's go and load those other scenarios. So are we sure we're going to override it? We go yes. And now we've loaded all of those scenarios that I had there before. So if we now look at, let's go back to our combo dashboard and we have a play with this, we can see these numbers changing, a lot easier and a lot better. So all of that information and the variations are showing. The scenario comparison, the same thing. We can see the impact of those different scenarios in here. So we can save one set and of course reuse another set. Any questions on that so far? Looks like the chat's pretty quiet. Everyone getting it, I guess. Okay, so when we want to do a weekly cash flow model, let's look at the different components. Here we have in Excel Cloud, different private clouds. We are going to have a cloud tutorial. So what we're going to do is open up a cloud workbook that's going to pull it down from the cloud into the desktop for our weekly cash flow model. So we are using the account transactions report. What this is doing is it's pulling on a cash basis, detailed transaction level information. We're syncing that to local data. We then pull that based on this information. That then comes through and picks up, again, populating this table of data on a transaction level. So here we can see multiple dates for particular transactions that are coming through. Again, we want to have a pivot table so we can slice and dice and look at all that information. Really useful to understand what's in the data. But of course, we want to pick up our cash flow model. We want to actually pick up a weekly. So this is the time series that I spoke about before that we have along the top. We have a start date of the model, and we're starting to use days and day counters. And so what we're trying to do here is we want to pick up on every 7th day is 1 week, and the following 8th day is another week. So we use the mod formula, which is modulation. It really allows us to, if for every 7th it becomes 0, and if it's 0, it becomes 1, and then we just add that incrementally. So if I just use F2 for the formula, it'll pick up the particular range for each of those incrementally. So now I have the daily information with a flag to the different weeks. So I can pick up weekly data. Here I'm going to have information relating to my opening balance sheet, my cash, and then this is where I show all my information on a daily basis. However, all the data, I don't want to, how do I get all this information into this list? Remember I mentioned to you dynamic arrays? Well, here's unique. Now, if I scroll down, you'll notice that the formula gets grayed out. So dynamic arrays allows me to spill information relating to that. This is picking up the account transactions out of the data set. So every single account name and the chart of accounts is listed here. If that gets updated, this will update automatically, which means that this list that I have here will automatically be updated. What we are doing, we're then using some ifs to pick up multiple conditions rather than nesting. We pick that up and we also multiply that by a positive and negative sign for expenses and revenue and certain balance sheet items to make sure we're doing the proper cash flow. And now we can pick up and aggregate all transactions on the 1st of June. Once we've got all of that and that all works down at the bottom, we then have our opening and then we have our movement in cash flow. To then build the weekly data set, so what we then have is we have the weekly time series running along the top. So we have our start, we already have it from the daily, and then we have here week 1, week 2, week 3, week 4, and all of this continues to evolve over time. There isn't any hard coding. We are basically building this structure automatically. So here we, again, using some ifs, and we're allowing to pick up our actuals. Our actuals run up to the week 8, and then week 9, we pick up a forecast. So in this case, we're using a particular cell. We're using a data validation dropdown. So if I change that to 3rd of August, then this counter moves over 1. So just a simple greater than formula within that structure, so that when we come to adding our actuals and forecasts, so here we have our forecast information, we can connect calculation fields to this, but ultimately this allows us to add the information to come up with our actual and forecast combined. So in this case, we have our week 8, and then week 9, our forecast kicks in. So as we refresh this workbook, we're going to have new data come in, we're going to have a reforecast, and we can start to get better at understanding the impacts of our cash flow when comparing the actuals versus the forecast. Once we have all of that information, as I said, we want to pick up what's the gap. So we want to work out, the whole purpose of doing this model is there a cash hole? What is the minimum? What does the cash balance go down to? What's the lowest point? Here it's minus 320,000. That's a fairly big gap that we have. So we put this into a dashboard. We add some words next to it. We divide by 1,000. What we're doing here is we're showing that in a chart. So I'm going to show you the chart in a moment. We're also going to have validation and error checks and making sure that those all are working correctly between weekly and daily. That's an important step. And here we are going to use information relating to how we categorize revenues, cash flows and outflows. So operating, investing, and financing. Dynamic arrays are quite powerful because now I can add, let's say this is overseas investing, enter, and now all of a sudden you can see that that's added to that list there. So dynamic arrays, again, we're using the unique formula. We're able to pick up that particular information. Ultimately, that allows us to understand cash in and cash out so that we can prepare this dashboard. Nice and easy. What's the cash gap? $321,000 that we'll just show that across. And what you have here is your cash balance. We can see there's a big hole, something going on here, and we can see what that relates to. There's a big cash outflow. And here we can see that it's relating to investing activities. So there's something that's happening in the investing activities. We can see our detailed inflows, and we can see that by the various line items here on a week-to-week basis. We can also change the time series if we want to have it on a particular date. So if we go back to look at what's giving us our problem. So I know, of course, because I've built this model before, a lot of that is in the deposits in the investment side. So what we're going to do is we're going to have a look at this block here. So this is this big hole that's been created. So let's say we're going to put in a 10 deposit. That's what we're expecting to invest in, but clearly we can't afford that. Maybe we go minus 50,000. Now I can go control enter, hold down control and push enter, and it sprays it across the whole range. That's a nice, easy way of doing that. I go back to my dashboard. That's all updated. So now the cash gap is 76,000. So not quite enough. So maybe we need to make the first two minus 10,000. Control enter, and that should hopefully help us out. So now the cash gap, -5. So it's obviously gone above the positive line. Then that's now $5,000. So having a dashboard, having it interactive is an important part of that. So going back to, I guess, what do we do next? So if you want to learn more about financial modeling, the Financial Modeling Institute is certainly one you can look at. The Financial Modeling Knowledge Hub, where we've got articles and information. The Financial Modeling Podcast with Matthew Bernath, Model Susan sponsored season 5. Definitely have a listen to that. There's a lot of information relating to that. And of course, YouTube. We've just launched our own YouTube channel, the EXL Cloud YouTube channel. This session will actually be recorded on that YouTube channel. So you can share it and you can come back and you can watch it as well. So it really helps you to understand how you can improve your financial modeling skills. We're also going to be running monthly boot camps for all EXL Cloud customers. So deeper knowledge, going deeper into the design and the scoping and the build and the visualizations and the dashboard. So how did I lay out those dashboards symmetrical, and how did I set it out is an important part. We're also going to go beyond just Excel and look at Power BI. So we've got tables, we've got data in tables. How do we then visualize that in Power BI? And if there's a bit of time, I'll actually go through that as well. Leveraging key skills and contents that are being developed. It's an important part of that bootcamp as well. So modeling challenges and community sharing is all going to be part of that. And it's a great way to advance your Excel skills for analytics as well as financial modeling. And that's all part of what we're going to be delivering on a monthly basis for all EXL Cloud users. As I said, this is the EXL Cloud content at the moment. There's pivot tables, there's actuals, there's budget, and there's a range of information that's available in the start menu. It is going to expand. We are going to be including other data sets as well over time. As I said, EXL Cloud dashboards. This is a performance report, position and return, which is more of a balance sheet. You can actually go to our website and download the PDFs. I will send you an email, of course. You don't have to worry about that. On where you can download that information. We will be sharing obviously the slides, and of course this is going to be recorded on YouTube, so you'll be able to have it online as well. Power BI is an incredibly powerful analytics tool, and the benefit of having data structured in a table straight into Excel means we can use Power Query to build it. So how you would do that is you would use your Power Query editor, you'd pick up the particular tables, you'd have a home page, maybe a navigation, You can have some dashboards and slices and tooltips. And you can start to bring information across other sources, Google Analytics and the like. So let me quickly open the Power BI, and I'll quickly show you that. So here we have a sales dashboard. We can select particular years. Here's all the different periods. All of this is using the same data from the different entities, EXL Cloud US. So we just select the other regions, Australia, Singapore, and UK. All of that information, we're going to take you through how do you build this. We have seasonality comparison between Google Analytics and your financials. And of course, you have Google Analytics data. Bringing that in alongside your financials can be quite powerful when you're trying to understand particular months and particular exposures or revenue or the particular industries. So all of that is quite useful. If I go to my Power Query editor, what I'll do is I'll quickly show you in here how you have your data sitting in your profit and loss. So we can have that information coming through. That's all the data that sits in that table that you saw earlier. And then now you just build your data model off the back of that. So yes, it is more complex. Yes, it's a bit more DAX and then script. But of course, that's going to be part of some of the training that we're going to be running through. So that's pretty much it. So I hope that that's been quite useful for everyone. We've got 10 minutes left for any questions. So if you do have any questions, feel free to pop them onto the chat. If there's anything that you want to find out more, of course, there's our website. And of course, I'll send out an email to everyone after this around the information when they want to find out more information. Silence. I guess that's a good sign to some degree that no one's got any questions. It's all pretty straightforward. Raymond, good to see you. Glad you could join us. Feel free to come off on mute if you want to. Thanks, Emily. Thanks, Raymond. It does work on a Mac, Jeffrey. You just need to run Bootcamp and Parallels. So you can run that on a Mac. You just have to run Microsoft Excel in a Mac. I don't like either of those. Yeah, I know that is a challenge, but that is definitely, it can work on a Mac with the caveat that you need to have those applications. 90% of the people that we train and use Excel use Microsoft Excel as opposed to Excel for Mac. Excel for Mac just doesn't have some of the advanced features that Excel does. Dynamic arrays, Lambda, and a lot of the other more advanced functionality. Certainly an area which is growing a lot. But yeah, appreciate the Mac users out there. But there is a workaround that is available. So the weekly cash flow model is, Charlie, it's not available yet in the content. It is available in the tutorial database. So what we are going to do is we're going to run boot camps and give people access to that. So what we are going to do is eventually release that into the content. So it definitely will be coming pretty soon. So I'll just trying to stop sharing. So yeah, it's not there at the moment, but it definitely will be coming pretty soon. Does the validation unreconciled bank transactions? Yeah, it's I guess if we go back, it's a good question, Paul. So what we do have is I'll just go back to, we do have account transactions and information that we can reconcile back to. So we're working on some work papers. So we have a transactions pool. You can do a bank transactions push, so you can push transactions that haven't been reconciled. At the moment, this account transactions pool is purely what's pulled in from Xero. So I don't think if it's reconciled yet by Xero won't recognize it. So I think it does have a bank source, but I think once it's reconciled, it goes through. I'll just have a look at the account transactions report. So there is received money from bank transaction. So it does feed through unreconciled transactions. Of course, when it's reconciled, it then applies that. So if there is a payment, but yeah, I'm pretty sure that is coming through as an unreconciled. In some cases, it might be unreconciled, but it's definitely worth checking on the Xero side for sure. Thanks, Paul. Sure, Raymond. Manual journals push. Absolutely. Let me just go to that. So what we have is the ability to push journals from Excel into Xero. So I click get, I get my list of entities, I put X next to the demo company, I pull the information. So now I'm pulling down the chart of accounts and the relevant information. Now I can select the different journal narrations. I can select my chart of accounts that I'm going to post to. I can select the particular, if I want to post it as draft, it's an inclusive, exclusive of tax. There's also the tax treatment. So we've got relevant tax treatment here, BAS excluded, GST, all of that information in terms of how it's set up allows us to do that. We give a journal number, and then we push that in. Of course, we need to make sure that our entries are balanced, our debits and our credits and the amount. This is very similar to what Data Deer had in terms of a journal push. So what we've done is we've largely replicated what they've got. And so we can post a whole lot of journals to particular entities just by selecting. It is on an entity by entity basis, but at least you've got the structure and the format. So what you can do if you've got regular repeating journals, which we have from time to time every quarter that we want to post, we can save this workbook. We can have all of it set up, and then you're just changing the debits and the credits every month. So you can automate the push process for your journal close at the end of every month. We also have the ability to push invoices and bills, and as I said, push bank transactions as well. So outside of just doing models, you actually have the ability to pull data and push data from Xero into Excel and vice versa. Any other questions? My pleasure, Raymond. Okay, got 3 minutes left. Thanks everyone again for attending. As I said, you will get a link to the recording, which will be uploaded to YouTube. I'll also send you links to where you can download relevant information. And also we will be sending out the slides so you can get that. And please spread the word and have a play. There is a 7-day free trial. And for those that are beta, of course, there's a discount coupon for 30% of 12 months. If you want to have a look at the website, there's a lot of information there. There's other videos, there's some features, and of course, there's the pricing. So definitely have a look and have a play. But in the end, it all comes back to the best tool on the planet, and that's Excel. And that's one of the things that we want people to embrace. Is using Excel, but using it better, more efficiently, and really making it quicker for you to build models, cash flow models, financial models. We are building a 3-way model that's going to come out soon, so look out for that. Thanks, Paul. Glad you enjoyed it, and we'll keep in touch.